Hello, everyone, and thank you for joining us for Mastering the Advanced Principles of Legal Accounting as part of the LTRC Industry Insight Series held every Wednesday. Our speaker today is Erica Birstler. Erica has nearly a decade of experience in the legal software industry, catering to the specialized technology needs of small to mid-sized law firms. She has given numerous presentations across the country on legal technologies, such as law practice technology management, cloud computing, and legal billing and trust accounting compliance.
Hello, everyone. Thank you so much for joining today and taking some time out of your day. As mentioned, our topic is focusing on advanced principles in accounting. So this is by no means a basics webinar. It's meant to kind of appeal to those, whether you're a lawyer, accounting staff, bookkeeper, accountant with law firms, to kind of talk about topics that are not day-to-day, a little bit more unique. So we'll start off today by talking a little bit about what legal accounting is. And the reason we're going to do that, not only to set a foundation and make sure we're all on the same page, but a lot of the advanced principles that I'll be talking about kind of pull from each one of the areas of legal accounting. So it kind of will set the flow of today's session. Then we'll go into 4 advanced accounting principles. Like I said, these will be based off of the different areas that I cover prior. Um, First, from a concept perspective, what it actually means, definition, and then how it applies to law firms. That's that legal accounting piece. And then lastly, what to keep in mind for your business. I think it's important to note that when it comes to accounting, you may have it might be a one-person show where you're kind of handling everything yourself. You may have accounting staff. Perhaps it's staff on site that may not be bookkeepers or accountants, but they're doing the accounting for you. Or you may have a bookkeeper or accountant that does all this work for you, 100%, maybe even outsource. So all of you have different setups. So I think it'd be helpful, and I tried to at least put together some questions that either you can ask yourself, you can talk with your bookkeeper, you could talk with your staff, just to kind of assess if these are things you want to implement in your firm, how to go about them, or at least know what you're doing right now and where to take it. And lastly is related to tools and technology. I think often we don't think of technology when we think of financials. You know, we figure it's very traditional, very black and white. But there are ways, especially with legal accounting, that having the right types of tools can really ensure accuracy, give your firm peace of mind, and allow you to produce the necessary reports that you need in order to do some of these advanced functions. I do want to give a disclaimer. This webinar is meant to be general law, knowledge, education purposes only. I do think and firmly believe that every law firm is a little bit different. So you do want to consult with your accounting staff, bookkeeper, accountant, whoever handles this with you, because there might be some specifics for your practice area, for the type of work that you do, for the size of your firm, that might be a little bit more relevant or a little bit different. So I do want to put that out there. I hope that this topic encourages just further conversation and involvement that all of you have in your overall running of your business. All right, so let's talk about what legal accounting is. So there's a few components in general. The first one is really what every business needs to consider. Your income, the money coming in and the money going out. You know, what are my overall expenses? What income is happening? My overall reports for tax purposes. That's just business, and that's fairly general across the board that every business needs to consider that. Then there's industry specific requirements. When it comes to legal accounting, we'll get into topics like matter cost accounting. That is the cost that you need to pay out of pocket for your clients that often need to be reimbursed, how to record those from an accounting perspective. Income, so this incorporates how your income or your payments, let's say your invoice payments, actually get recorded from an accounting perspective, both from a order of allocation to those different accounting records, but also the differences in how you want to track income. And we'll talk a bit about that today. Every firm's a little bit different as to what's most important to them and what data is valuable to them. And a lot of it comes down to where the income is coming from. And then lastly is fee advances or retainers. That's typically trust accounting. We'll be touching upon trust accounting today as well, and how that, again, impacts your business as well as your work with your clients. So we're going to be taking a advanced principle from each one of these. Some of these you may be well aware of, you might have experience with, and some of you may not. Not all of them are requirements for you, but many of them are in place to help you really analyze your business, how well it's doing, and possibly make decisions to take it either in a different direction or continue to move in the direction that's working very well for you. So it's important to understand that while we all think about compliance when we think about accounting, I want to do what's right. Also think about you want to do what's right for your business and the success of your business long term. So the first area that we'll cover is business accounting. Now, like I said, this is kind of general across all businesses. And so the advanced topic that we'll be talking about here is actually for any business. It's not just for law firms, and that is class-based accounting, also known as class-based reporting. It is a general accounting term. Like I said, basically it comes down to being able to track and report on income, expenses, net profit by a specific class. Also could be referred to as a profit center. Those who are just basically trying to centralize where the profit is coming from. And for different businesses, you can have different office locations that you want to track, maybe different product lines or services offered, or maybe they have different types of jobs or projects that they want to track. So you can see how this can apply really to any type of business. It's basically a categorization, but it allows you to specifically see the profit associated to those categories. I do want to note that if you have multiple businesses, and some of you do, you want to still keep those segregated. Each should have their own set of books. And when I say a separate business, that means they're separate entities from a tax perspective. If you have those separate entities, they should each have their own set of books, meaning their own general ledger. And then within those, you can have classes if need be. All right, so when we talk about profits, let's think of what would be helpful for a law firm. So these are a few examples that are quite common across different sizes of firms, different types of firms. And I think for the most part, many law firms think of fee. Okay, I need to focus on where the fee comes from and where that's being brought in. But it's not just about fee. Classes typically apply to all types of transactions: firm transactions, client transactions, income, expense, across the board. So here are just a few categories that, again, are typical examples, but you may have more. Attorneys or parties. So that could be originating attorneys, the matter owners, timekeepers, anybody involved on a particular case. You may want to track the money in, but also the costs that they incur throughout that case. Areas of practice. One good example is, so if I have, let's say, family law as a practice area in my business, I'm a general practice, but family law is one of them. I can track the fee brought in, the cost brought in, but also when we talk about cost accounting, we'll get into this as well, the different types of costs. So maybe my rent, for instance, I want to allocate, or rent's a bad example, let's say advertising. I want to allocate my advertising across all of my practice areas, maybe even by different percentages. That can factor into class-based accounting. So it doesn't specifically relate to a matter or a case or even a family law file, but you could take an overall business expense and split it in a particular class. So that way, when you run, let's say, a P&L for my family law side of the practice, it will factor into that. So it takes firm expenditures into account as well. Departments, if you're a larger firm, a larger business, you might want to look at different departments. You might even have a marketing or a sales department. You might have a larger staff that you want to look into. and multiple locations. As long as you're in the same entity, like I said, the same tax entity, if you have different offices and you want to see the profit or the activity that's going on in those offices, classes can help with that. So I mentioned at the beginning, we'll talk about questions that you should think through. So that's what this firm assessment slide is for. So to assess your firm and whether or not this is even needed, and if needed, how you want to go about doing it. So first is to figure out which classes make sense for your business. This is, I think, one of the main reasons why this is considered an advanced principle, because it requires some thought. You need to think through what makes the most sense, what information would be helpful to me to make the right decisions for my business is how you want to think it through. I gave a few examples on the prior page. Attorneys, practice areas, locations, those are kind of the most common. Does your accounting tool provide class-based reporting? Now, it is a generic accounting function, so tools like QuickBooks and similar to that usually do have class-based reporting. There might be a categorization tool that your accounting tool has, but look into that. See if it's even possible with what you're using right now. All transactions have to be assigned to their classes. So there's a bit of work here. You first have to determine which classes make sense for you. And then when those transactions happen, so I gave that example of advertising, I need to assign it to the appropriate class when that comes in. Again, you may not be doing this work. It might be a bookkeeper or an accountant, but a conversation needs to happen. If you don't assign those transactions to the proper classes, then you won't have any data to work with. So it's important to make sure that it's actually being utilized and not just set up. You may need to split, which is the example that I gave before. If I'm doing advertising in general for my firm and I want to split it across, maybe one advertising is in a family law publication, something else is in real estate, and I want to divide it accordingly. Very often, tools that support classes allow you to split either by percentage or by dollar amount. And then you want to use this data. All of this information that you're collecting is useless if you're not reporting on it. So there may be a function like a P&L by a class, for instance. So if you have a family law class and you're utilizing it properly, you can actually see the net profit for that particular practice area. So imagine the benefit of having that type of information and being able to move forward with your business based on that. All right, our next section is cost accounting. So cost accounting is pretty much as it sounds, the tracking and posting and reimbursement of various costs. This could be your business expenses, it could be client-related expenses, and it's good to be mindful of what's going on with costs because those are areas, if needed, you might be able to cut back on or maybe reassess, but you don't know how you're doing with handling your costs unless you're actually tracking it. So from a general concept of cost accounting, it's of course tracking costs based on maybe a particular project that is being worked on. For a law firm, that would be a matter. Ensuring that you're actually getting reimbursement on those items, because if you don't, that does affect your income. So following that cycle through. Understanding indirect versus direct costs. So this is a general accounting term. It goes, again, for all types of businesses. Indirect is something that is associated to something indirectly. I'll give a law firm example, which helps a bit. Let's say overhead, like an overhead expense like printing or photocopies. That is an indirect cost because you're not going someplace and paying per copy and charging it to your client. You just have general, printing, like ink costs, paper costs, maintenance on your printer, and then you're indirectly passing a portion through to that to your client. That's indirect cost. Direct is when you're referring to, no, I'm paying this filing fee today for this specific client, and I need to be reimbursed for it. So there could be a relationship one way or the other, and they're recorded differently based on how they are incurred. And then asset versus expense. So this is more so for law firms, believe it or not. Generally, with most businesses, expenses are recorded as an expense. So goes into an expense chart of account. It might be named something different. You might have different types of expense accounts, but it goes there. Assets is typically only used when purchasing large items, like maybe purchasing a facility, an actual office space, buying that, or furnishing, different types of furniture or larger purposes associated to that. Usually something that can accumulate value over time or even depreciate over time is recorded as an asset. Now, law firms are a bit unique because in addition to just your overall business expenses, you do have those that have to be reimbursed by clients. And how those get recorded do matter based on the type of work that you do, which we'll talk about now. Okay, so for law firms, hard cost versus soft cost. This is basically just another term for direct versus indirect. Hard costs are considered direct costs. Soft costs are considered indirect costs. So those examples I gave prior still apply. A hard cost would be a direct, that filing fee example. I'm going to court, I'm paying a fee, I need to be reimbursed. Indirect is that photocopy or printing example that I gave, also known as a soft cost. I'm paying some expenditure towards that, and I'm passing a portion of that through. You want to make sure that whatever tools that you're using, you're able to account for both. Now, some firms don't actually pass through soft costs. Some choose to absorb it, and that's a business decision you need to make. Non-reimbursable, you may come across certain costs yourself that you choose to absorb. It may be a soft cost, or let's say you have a fixed fee where you're going to charge $5,000 to do this project, and you're choosing to include costs in that fee. You're not charging costs on top of that. So if you do have a filing fee, if you do have a court cost, you're choosing to not itemize that and pass it through to the client. You'd record that as non-reimbursable because you're including it in your fee. So you need to have a way to be able to track those. Asset versus an expense. So here we're getting deep into accounting. And again, we're not here to give accounting advice. You still want to discuss these with your bookkeeper or accountant as to what makes sense for your business. But in general, if you're recording something as an expense, it's something you anticipate being reimbursed for in the short term. Something that you would not mind recording as an expense on your taxes for usually the current year. Asset is typically for those that may be long drawn out in getting reimbursed or not reimbursed at all. Common examples of that are contingency work. You may not get paid if you don't win that case or that settlement. So very often those are recorded as assets. Again, I'm giving a generalized example. You still want to sort that out, but there are options. Expenses are usually called reimbursable client costs. An asset is usually called an advanced client cost, and firms differ in how they post them, but that's kind of the general rule of thumb. And in regard to how these costs are handled, so you see there's a lot of different things I'm talking about with costs. Is it direct or indirect? Is it reimbursable? Is it for a client? Is it asset or expense? Most of these just require a one-time setup or a one-time conversation, and then you follow that going forward. So you might just ask your accountant or bookkeeper these questions. How are these recorded? And everything might be, right on track. But the billing side is something that is so crucial and often not thought of. So if you have these costs, so let's say you're in your accounting software, QuickBooks or something similar, you're recording all these costs, they're recorded as an expense, things are looking great, but how do you make sure they're billed to the client so you actually get reimbursed? So the accounting side is all good and great, you have it posted correctly, but if you don't bill it to your client, you're not going to get reimbursed. And if you're not reimbursed, that actually takes a hard hit to your income, your overall profit. So that's something to be very mindful of to make sure that you are doing everything you can to bill these items to your client if they're billable. A couple examples, again, from an accounting perspective, just to explain what's on the screen. So this is an hourly matter. The left side are the different costs that I have for this hourly matter. The right side are the different accounts. So for this matter, I chose to record it to an expense account. So on the left, I have some filing fees. That's a direct cost. So that is a reimbursable client cost, which is an expense account. Transcription fees, that's a direct cost. Reimbursable client cost, very good. Photocopy, that's indirect, as we mentioned. So that gets recorded as an indirect reimbursable client cost. And auto mileage, in this example, I chose to not charge my client for auto mileage. So I'm recording that as a non-reimbursable client cost. So those are different examples as to how everything on the left is an expense related to my client, but the variance in how they could be posted on your general ledger. Now let's talk about when you receive payment. So I billed these to my client, I received payment. First thing to note is how that payment will get allocated. This is most relevant for partial payments. So if I have a $1,000 invoice that is made up, let's assume it's made up of all of these things. I have some hard costs, soft costs, finance charge, fee income. Let's make that assumption. If I get a partial payment, how does that apply to all of these items? What it should do is it should cover in this order. So it should cover your advanced client costs, if you have any, first, then your hard costs, then your soft costs, then any finance charge or late fee, and lastly, your fee income. That's the order it should do. Now, general accounting software, like QuickBooks and similar tools, they apply proportionally to all these items. The issue there is you might actually earn fee before all of your costs are covered, which can cause complications with fee distributions and that type of reporting. So once that's paid, then the payment comes in. So again, the left are the same expenses we reviewed before. The middle is when I incurred those expenses, how I posted them. And the right is once they're reimbursed, what they get accounted for. And these are all income accounts. So it's different. You see in the middle column, it's reimbursable client cost. In the right, it's reimbursed client costs. The middle column are expense accounts. The right column is income accounts. So here we have those three examples. The first two are the same. The third one is indirect. And the non-reimbursable is none because I chose not to charge that to my client. Therefore, there is no reimbursement that takes place. Firm assessment, what to keep in mind. How are you designating matter versus firm costs? How are you clarifying the difference? If you have postage related to a client, it should not be recorded the same as postage that the firm is incurring themselves, because one of them is hopefully going to get reimbursed. How are you tracking direct versus indirect matter costs? As I mentioned, you may decide to not pass through indirect costs, or maybe you do. How is that being entered from the accounting side of things? And also, how is that being billed for to your clients if you're seeking reimbursement? Are you recording your cost account appropriately? We talked about an asset versus an expense. What makes the most sense for your firm? It can be based on the type of billing that you do, in addition to other factors. Ensure the right accounts are being used. If you're using a tool that allows a lot of flexibility, often it's very easy to choose the wrong accounts. So the more restricted your accounting tool is, or the ability to restrict or default these types of items, the better. Are your costs currently being covered first when you have those partial payments for invoices? And have you run a cost analysis? Do you know all the costs that you pay out of pocket, how many of those have been billed to your clients, and how much of them have been reimbursed? I highly recommend doing this cost analysis because likely you all know that your costs are dropping, you just don't know how much of it. And that can factor greatly into your overall net profit. Our third item that we're going to talk about is in the area of income accounting. This is what I mentioned before that, the money comes in, great. Well, there's different things that have to be done with that money or recorded. It's not just one, it's in the bank account, that's all I care about. There are different segments to that income. Very often, there's this concept called fee distribution. Now, this is not common in other businesses, but it is common in law firms. Basically, it means when the fee comes in, so your income, I mean, you can get income for reimbursed costs too, but in general, your income, you're a service business. So the service you provide has a fee, and that is how you bring in your income. Other service businesses might have like a commission structure or an incentive structure, which is kind of what fee distribution is, seeing who brought in what, and in some cases, providing a compensation for that. Also, many sales roles may have some sort of commission structure in place. For law firms, it can be similar, but it also could be a little bit different, a little bit more complex. The reason I say that is you could have John Smith is a lawyer on a particular matter. He's also a timekeeper. He's also originated this file, and he can get 5% for originating, 10% for being the responsible, and 30% of his own work as a timekeeper. So imagine how complex that can get over time. The benefit, though, to having fee distribution is the whole idea is to incentivize your team. You want people to bring in more business. A primary example is originators. If you have certain lawyers at the firm or even external law firms that are bringing business into you, very common example is if you're in a specific practice area and you're close with another firm that's in a specific practice area, when they come across work that's more relevant to you, they may pass it your way. You want to incentivize that if at all possible. The type of cases you do in the practice area may have different rules about that, so keep that in mind. But that's the idea of fee distribution, is just to have incentive behind bringing in that income. In general, you want to focus on collected fee. That is if you're following cash-based accounting. So majority of law firms in the United States follow cash-based accounting. But if you are larger in size, you may follow accrual-based. The main difference is when that money gets recorded on your books. Is it when you bill? That's accrual accounting. Or is it when you have cash in hand, when you get paid? That's cash accounting. So depending on how your books are being managed, like I said, most law firms are cash-based, depends on whether or not you want to focus on billed amounts or on collected amounts. Which parties are originating or producing the most income? Like I said, you want to encourage that activity, but you don't know how to encourage it unless you know who's doing what. Some things to keep in mind. Is fee-based tracking or compensation even needed? Now, you may not want to compensate based on fee, but maybe you just want to know. It's good to know. I have, 4 timekeepers here. Who's billing out the most and who's collecting the most? Some firms actually make their timekeepers or matter owners responsible for their collection as well. So that's a way for you to see what the performance level is from each person. But figuring out if it's even needed. Also, the percentage factor, saying that a mat owner gets kind of compensated 10% of all the fee that comes in. Is that something you're doing or something that you want to consider? You want to define the parties and their roles. Each matter, you should know who the originator is, who the matter owner is, and who the timekeepers are. How are you determining the fee collected? So you want to make sure that each invoice payment, you're able to strip out what portion of that is fee and what fee is associated to each person that worked on that file. Do you wish to apply a percentage? Like I said, you may or may not. What about fixed and contingency cases? Because a lot of the times this fee is based on hourly work. How many hours I've billed, how much of that was collected, but you also could have fixed fee cases where people are contributing at different levels on that fixed fee case, and you may want to compensate for those accordingly as well. And how often do you want to do distributions? If all this sounds great and you want to do it, will it be biweekly? Will it be monthly? Typically, it follows a payroll cycle, but these are fairly complex calculations. So you want to be mindful of not doing them as often. Usually about once a month is typical. Some even do once a quarter. And our last item is in trust accounting. So you all know what trust accounting is. You all have experience in it. Basically, those funds are held in trust, but there's a lot of complication that can happen when those funds are moved from trust to your business account when they're being earned. Usually the money, not all the time, but very often the money in trust is retainer-based or something that anticipates on being earned in the future. How does that process happen, and what are the steps you need to be mindful of? So there's 4 main steps. Now, what's interesting about trust accounting is it involves both billing, because like I said, if these are retainers, you want to have that retainer balance available and you'll likely apply it to invoices, but it also affects accounting because it's a bank account. You need to print checks, you need to do reporting, you need to reconcile. And if you have any sort of segregation between those 2 records, you can have a lot of challenges in ensuring all these steps take place. So if I'm paying an invoice from a trust retainer, the first thing that happens is the invoice has to be updated in terms of payment received, balance remaining, what the billing balances are. So what is owed on that client file. Also, if there's any retainer balance, that too has to be updated. You need to debit the trust bank, both on the bank account level and also the matter ledger for the amount of that invoice. You need to make sure you don't overdraft in doing that. You need to credit the operating account. That's money going into the firm as either income or reimbursed cost. And then from an accounting perspective, when you handle trust funds, they are managed as a liability, but when you earn them, that shifts over to income. So there's a lot of shifting that's happening here. If you're using a legal specific billing and accounting tool, some of this may be automated. A lot of it may be automated, but if you're not, especially if you have those segregation between those two functions, you want to figure out how all these steps are happening and that they're happening correctly. And at the bottom here I mentioned, is it an individual or bulk transfer? Are you, at the end of the month, you have 10 matters that you want to pay from trust? Are you cutting 10 checks or doing 10 wires? Or are you doing one wire that affects 10 different matters? And if you're doing a bulk transfer, you need to be very mindful from a compliance perspective that you need to show the full transaction amount. So whatever, let's say it's a wire, whatever you wired over, the full amount, but it needs to link to each respective matter. Their portion needs to be on each matter ledger, and it needs to be associated. So if you are trying to make a change, it should all be tied together to prevent those changes, because that one transaction affects 10 of your clients. So things to think about. Are there any gaps in the workflow of your trust payment? So those 4 steps that I mentioned, think of how your law firm is currently doing those, and are there any challenges there? Are your trust balances accurate per matter? Especially if you're managing duplicate records, you may notice that they're more accurate in one place than another, and that can cause huge concerns, especially from a compliance perspective. And overall, do your accounting and billing tools support trust compliance? Do they not allow overdrafts? Do they not allow commingling? Do they require a trust matter to be associated for every single trust transaction? Do they have the reporting that's needed for you to do your reconciliation and your passing of an audit, and all of those normal requirements of a trust account? And the final point is, as we said, we're going to wrap up with technology here. You just want to make sure you're using the right tools. The different concepts that I talked about today, a lot of them involve both the billing and the accounting. So you want to make sure that you have a complete view of all billing and accounting information on each matter, just to ensure accuracy, also make that workflow as seamless as possible. If you're using legal accounting software, which I hope you would, especially for financials, look for defaults. You know, if every time I do this type of cost, it always goes to this account, that's extremely helpful for accuracy. Settings, similar to defaults, but let's say I have certain vendors that I want to go to certain accounts, or certain classes that I want set up. Those are settings. And different tools. So like that bulk trust transfer to operating, is there a tool to utilize that in your billing software? Because it's a billing activity, but it also affects your trust transactions. And just make sure you have the required reporting, not just for compliance, but for all this analysis. I talked about a cost analysis, we talked about class-based reporting, obviously your trust accounting as well. Do you have the necessary reporting to take this valuable data and be able to make the decisions that you need to? Okay, that's it about our topic today. Of course, if any of you are interested in learning about CosmoLex, we are an all-in-one cloud-based practice management software that includes everything you see here, including legal accounting. So if you'd like to learn more, please feel free to reach out. And I think now we'll go ahead and take any questions.
That's all the time that we have for today. If you're curious about our question and answer section, please view our live webinars. If you are curious about future webinars, please check out the ABA LTRC page or follow our Twitter at LTRC for updates. I'd like to thank our sponsor CosmoLex and all of you for attending our webinar today as part of the LTRC Industry Insight series. I'd also like to thank Erica for presenting today.